Rohr here with an early global view on Tuesday, March 10th, 2015. It is currently 7:20 a.m. U.S. Central Time, coming to you a bit later than usual because we wanted to catch up with a key piece of data that we'll share with you shortly. But for the most part, we have to allow that the data remains weaker than expected, other than that major uptick in U.S. employment last Friday. Let's take a look at what this means to the markets. Well, we're off 18 points today. This is the S&P typical hourly on the left, 30-minute on the right, and that puts us down into the 2060 area. Now, while that's a new low for this overall sell-off, it's not necessarily a disaster because we'll take another look at the intermediate term charts, how 2060 was the big congestion level coming in during January that the market failed off of after the upbeat January non-farm payrolls because of weak hourly earnings, and was quite a big congestion level. Now, whether or not we can hold 2060 to this Fibonacci retracement around 2058 is going to be very important, though. Much below that, you might be headed back towards something more like 2040 to 36 again. So kind of a big decision for equities today that are starting off stale on, again, those concerns over weak data and especially the Chinese disinflation and weakness possibilities. And what we had in any event was the old violated 2088.60, that was 70 rather, that was the old all-time high from back in December, and that would have been resistance even if the market had made it up there late yesterday, early today. Instead, it just squeezed temporarily above the 2078 to 75 heftier congestion from back in December. That's been another important level for this market, and being back below it again overnight from shortly after the U.S. closed yesterday was not a good sign. If it should rally back up, in fact, you'd have resistance right back up into the late trading yesterday, anywhere back up into 2075 to 78 again, which later this week will be reinforced by this continued slide in this upper channel resistance. And also note that on today's gap lower, it's likely that the hourly MACD slides back below the lower runaway band after cleaning up marginally above it late yesterday. And that pretty much does it for the short-term view of the S&P 500.